This podcast is brought to you by Independent Building Advice. IBA acknowledges traditional owners of the land and waters this podcast is recorded on. If you find this episode helpful, follow us for more so we can continue putting out free value for all homeowners in Australia. It really goes a long way. Enjoy the episode.
All right, welcome back. We've got another podcast. We've got Glen Austen from Tag Finance, 20 years finance broker. There are different finance brokers out there. They're ones that, they're people that work for banks directly. There are finance brokers out there that, you're in the room here, but I'll compliment you anyway. They do a good job, but they don't really know the ins and outs. And I think the devil is the detail with finance. And Glen is absolutely, every question I've ever asked you about to answer on the spot. And what I love about it, if you don't know the answer, you'll research it, come back to me, which is pretty cool. And you've got a great manner with clients. So we want to get you on board today. Welcome aboard.
Thank you very much. Thanks for having me.
Yeah, thank you. But we want to ask you some questions that are relevant to our listeners that we think are key to know, and really get your insights as a professional into finance from your vantage point rather than what the clients think. And I think there's a lot of myths around there of what people think about finance. And I guess one of the biggest ones here is often you hear clients, normally the older generation, they turn around and go, we're just going to go directly through our bank because, we've got a good relationship with them. We've been with them for 30 years and, we've been so loyal to them. We're just going to go straight to them because that's the best way to go forward. Now, I disagree with that, but I could be wrong. You're a finance broker, obviously you deal with lots of banks. What's the thought process with that? Is that correct, wrong, right?
I don't know that there's necessarily any right or wrong. I guess the way that I look at it is that even though you may feel like you're loyal to your bank, there's going to come a time where your bank's not going to be loyal to you. And that can quite often be something to do with, case in point at the moment with a lot of the banks out there is that the best interest rates on offer are available to the brand new customers, not the loyal ones who've been paying their mortgages on time every time for the last 20 or so years or whatever it may be. Yeah. And quite often those loyal customers are the ones that actually have to fight a whole lot harder to try and even get their rate reduced to something comparable to what the brand new customers are getting that are coming from another bank and know nothing. The bank knows nothing about those people, which seems a little bit back to front to me. But that's just the way that the banks operate. They work on the premise that the majority of customers aren't really ever going to ask the question or aren't really going to push the issue. They feel like they're on a good wicket and they'll continue to run with it. Whereas we as brokers, we've got all the banks at our fingertips. We have no specific lender that we're trying to take you to. We're not going to steer you in a particular direction. Our role is to get the most suitable loan for you, depending on your needs, requirements, but more importantly, your circumstances. And sometimes the bank that you've been loyal to for however long may not like your circumstances and not give you a loan anymore, whereas the bank next door might.
Yeah, it's interesting. Like I've signed up for subscriptions for things before, and when I've gone to cancel it, they've offered me a discount. And it's like, why didn't you offer me a discount earlier? Like, why are people getting better rates than me when they're not? And you're right that with banks, they don't really reward that loyalty. I mean, I'm sure some do, but they don't reward that. They just, we've got that business. Let's look at the new business. But if that old business leaves, well, then why wouldn't you look after them better? Why isn't loyalty rewarded? And I think that's a major thing to look at it. But also, what you just said there, and you sort of brushed over it, but to go into more detail, when you say that banks look at you differently, they all have different policies. Can you just go into more detail there about how their policies might be different for each bank and then how that actually affects the person looking at getting the loan?
Every single bank, the same person can go to every bank and they will be assessed differently on how much they can borrow and whether they qualify for a loan or not. A really good example of that, CBA, biggest bank in the land, always comes to mind on this because there's so many people out there that have had that Dolomite account since they were a little kid. Great marketing by CBA, Fantastic. Get the kids in young, get the parents on board as well, but they have these Dolomite accounts. They eventually get to that point where they want to go and get a home loan. Now, when it comes to getting a home loan, this is going to depend on how much deposit they've got, all these kinds of bits and pieces. But more importantly, what sort of income are they earning and how long have they been in the job, or are they self-employed? And if they're self-employed, how long have they been self-employed? And if any of those different aspects to that person's particular situation do not tick the policy of CBA, who we're talking about in this particular scenario, then CBA can't give them a loan or won't give them a home loan.
Yeah.
Now, that doesn't mean that ANZ right next door won't give them the home loan. And these are the things that, as finance brokers, we need to be all over. Stay on top of the different policies of the different lenders because they do change fairly regularly, and we need to know what's happening at any given time.
Yeah, I think that's paramount what you just said then. I've had clients that have been flat out rejected from their bank that they've gone directly to. They said, we can't get finance. They feel dejected. They've just designed a great home. And I'm going, no. Go to the bank next door. Like they said no, but their policies are not for you. Their policies are for people with a bigger deposit or, older or younger or whatever it might be. They've got their key client they want. Go next door. And they feel dejected. I have to work really hard to convince them to go to a broker or go to yourself and go, okay, try next door. And then all of a sudden they can get finance. They're back on track again. But because if you're only looking at one policy, it's like, I'll use the analogy. It's like, obviously we do. We have lots of builders similar to finance. That it's like going to a department store like David Jones and trying to find the toaster you want. You've got all the options there in front of you, being a finance broker. But then if you go to the one shop that's like a Philips, they only sell Philips. I'm going to tell you that Philips is the best, but that may not have the product that's best for you. And I think that's the power of looking at the whole smorgasbord of finance options and going, okay, this suits you the best, and then try and explain to the client why.
Yeah, and an analogy that I've used in the past that I believe you're familiar with, Behan, is that when I first sit down with clients, I feel like I'm sitting in a long corridor and there are doors open all the way down the corridor and a door at the end. And every single one of those doors is a different bank.
Yeah.
And as people are telling me their particular situation, their scenario, whether they've just had a baby or there's a baby on the way, or whether they've just gone self-employed or they've been self-employed for 10 years or they've just got a brand new job and they're on probation, or they're working casual now because they don't want to work full-time anymore, or that's what the industry specifically dictates that they need to be doing. As they're telling me this, in my mind, I'm shutting the doors of the lenders that I know they just aren't going to qualify for.
Yeah.
And then eventually the goal of that is to get to a point where I've got 3 or 4 doors open, and they're the 3 or 4 lenders that I think, right, these are the lenders I know that you're going to tick the box with. I'm now going to go and approach them and play them off against each other and make sure that I find the best solution for you to get you what you need.
Magic, absolutely. Yeah. And you were saying earlier, so that can evolve over time. Like you might, if you've got a 30-year loan, it might be great today, but that might not be the best option in 2 years, 3 years, 5 years time. Is there like a review process that you guys follow with that sort of element of it, or is it?
Yeah. We have a set review process in place. It's evolved over the years, but we do our follow-ups after settlement. We have our 3 months, our 6 months, 12 months, and then it's annual. But quite often, I guess a key thing to remember is sometimes when we're dealing with people whose circumstances are whatever they may be, sometimes the solutions for them at that point in time are limited. And I'm saying to them, like, this is not the ideal loan that you're probably after, but right now, for you to be able to achieve what you're trying to achieve, whether it's buying the new home, building the new home, renovating, whatever you want, this is the one that's going to provide the solution to get you the loan to complete what you want to do under your current circumstances. However, in about 12 months' time, we're probably going to need to review this because I don't think this is the lender you're going to want to stay with, because that loan's not going to be... It might not be a mainstream lender, for example. We might be going to what you call a second tier or even a non-conforming lender because of whatever that circumstance may be at that time. But we know that that's going to be cleared up in about 12 months' time. Credit file might look a bit better, or you might be self-employed for that little bit longer and you start to qualify for some of those other more what we would call mainstream lenders. And then we're going to look to take you there, get your rates down, put you on a better deal, and away you go. So
just to put that into a more basic scenario, is that if someone is basically in a situation where they are not, they might not have the best credit history, or there might be something there that, they max themselves out, that you wouldn't go to the normal banks, you'd go to another lender that's not your mainstream, like you said, but a lender that you go, okay, these guys think a bit outside the box, they might charge a higher interest rate, but they will actually accommodate what you're after. You then get them the finance, get them in the door, get the project underway. Then when the equity or the situation's changed, or their pay rise, whatever, then you review it again and put them through a better interest rate. Is that?
Absolutely. Yeah. I mean, my goal every single time is to get the absolute best solution for that client. Get the best deal, best rates, all those kinds of things with a lender they may prefer to want to be with if that ticks the boxes. But sometimes that's not the case. And most times clients know when they come to see me that's not the case. Sometimes that's why they're in front of me. But we can get the solution now. And that doesn't mean that you have to stay with it. this will get you where you want to be, and we'll sort it out in about a year or whatever's time when your circumstances change, and we can get you back where you want to be.
Magic.
So, yeah.
But I guess you've got to find out what the other options are for you to make a wise decision whether the bank you're staying with is right. Like, for example, if you worked out, with CBRE, for example, and you go, okay, so with, what did you say?
CBA.
CBRE. That's an insurance company. So you're with CBA, and they actually say, look, this is your interest rate. You don't know if that's good or bad because you don't have something to put it next to. So that if you actually have another bank, actually that's better, but it's only slightly better, I'll stay with who I am, or stay who I'm with. Or, you know what, that's actually a lot better, it's actually worth the change. Yeah. And I guess that's what you got to sort of, you don't know unless you know.
You don't know unless you know. I mean, there's a lot of information online these days, as we know, but again, it's a lot of us try and go online for our medical advice. Is that the right thing to do? I don't know.
2 weeks to live.
Dr. Google. Yeah. So that's no different with home loans as well. There's a lot of policy and all these sorts of bits and pieces, intricacies behind the scenes that most people aren't going to be aware of, and you're not going to find that online when you're searching. We have that information, and we're trying to provide the best solutions every single time. We are a relation-based industry compared to a bank, whereas a bank is more transactional. So you go in there, there's no relationship that you're going to have with the person who you may be talking to at the bank or meeting at that point in time.
Yeah.
And there's a very, very high chance that next time you go back to the bank, that person's not going to be there, because banks do move their staff around deliberately. That's a purposeful thing that they do. So with us, we are transactional. We're all relationship-based. We want you to have the best possible experience we can, because we want you to come back. But not only that, we want you to send your kids to us, your friends, your family, and all that kind of stuff. We're small business, and that's what we're trying to do. So it's very much relationship-based, and we've got to make sure that whatever we do for our clients, we're looking after their best interest before anything else.
So how does it work when you've got a mortgage, but let's say it's a lower mortgage, but you've got, let's say you've got a $1 million home valuation, but your mortgage is $500,000. How do you access the equity from that? What's the process between that? How do you go about getting that, and how much you can use of that? Can you just walk us through that? So for an extension or renovation to your home, or it might be you're buying an investment home, or how does that sort of all work?
A couple of different ways to answer that, but I guess the starting point that I would sort of make most people aware of is that the equity in your home, technically what you're doing there when your house goes up in value, your loan goes down, you're building up this equity in it. And that equity, really, the way I look at it, that's a vehicle for you to do whatever the next transaction might be. So if we're talking about $1 million asset or $1 million home value, and we've got $500,000 owing on it, general rule of thumb is that we can go up to 80% of that value. So up to 80% of $1 million property is $800,000. That's how much we can borrow against that home before we actually get charged things like mortgage insurance and stuff like that. So ideally we want to try and avoid that, because that's going to be extra fees and a higher interest rate and those kind of things.
So you get $300,000 in equity because
correct.
The 80% minus what you owe.
Yes, and that's exactly how it works. Is you borrow this $800,000 is the max we can borrow against the house. So if that's the case, and you've already got $500 owing, $300 is the extra we can get out. Now, depending on what the plan is with that $300K, will depend on how we structure that loan. If that $300K is a deposit on an investment property, we'll keep it completely separate from your home loan, because they've got two different purposes and two different tax benefits to it.
Awesome. Yeah.
So, but accessing that $300K is as simple as a normal home loan application. We're just not borrowing the money to buy a home. We're borrowing the money to get that $300K out for whatever the purpose may be. So deposit on an investment property, renovations to a home, which we can come back to a little bit shorter, because if that renovation is going to be quite substantial and structural, which I imagine we are going to be sort of alluding to, that generally what we're going to be doing is we're going to be getting a copy of your build plans, contract, etc., and what's going to be changing on that home. And we're going to get a valuation done, which is called an on-completion valuation, based on this is the house now, these are the works that are being done, what do we estimate the house to be worth at the end? And if that means that $1 million house goes to a $1.2 million house, now we can borrow 80% of the $1.2 million end valuation.
Absolutely.
All right.
Now,
slightly different.
Now, I mean, I know most of these answers anyway, but I'm asking for the people listening. But obviously, that's not you going, saw my neighbour's house, and I think my house is worth is much better than them because we have nicer taps. It's worth $200,000 more. It's not a It's not your personal valuation. It's actually done by a licensed valuer.
Correct.
Yeah, because obviously they're looking at historical history of relevant size and shape, blocks and houses.
Exactly. They're looking at the most recent sales of similar type dwellings, and quite often we're talking about the end of what this renovation is going to do, right?
Yeah.
So we're talking about maybe a 5-bedroom, 3-bathroom house in a particular area with a double garage, etc., on 800 square meters, just random.
Yeah.
And they're going to look at recent sales of similar type houses in the area and go on, what have they sold for?
Yeah.
Now, if that's $1 million home, for example, and you're doing a $400,000 renovation to it, adding the two together does not mean it's going to be a $1.4 million house at the end. They're going, well, part of that house is changing.
Yeah.
The $400,000 is being spent to change a lot of that stuff. So that million plus the 400 may end up coming in at around about 1.2, because that's what the market has said similar type houses like that have sold for in the last 6 or 12 months, and that's where the valuer is getting their information from.
Gotcha. So they take into account that, like, house A might spend $150,000 in their renovation on their kitchen, and then house B spends $45,000. Do they take into account like the kitchen layouts, or is that just washed over, or how does that sort of work?
No, definitely. So whenever I am looking at whether it's a brand new build or a renovation, one of the things that I'm always saying to my clients is, okay, you've given me this build contract, you've given me the plans, that's good. I need the specifications as well. And the specifications, for those that aren't familiar with what it means, is that literally, what's this fit out going to be?
Yeah.
Are we talking about single bayonet lights in rooms and laminate bench tops, or are we talking about dimmable down lights and stone bench tops and all the top notch fittings, which is very, very different. So what we're trying to do before we order a valuation, I get as much information as I possibly can, because even if there's things excluded from that build contract, I'm like, what's your plan with this? Oh, we're going to get other trades to do it. I'm like, can you please go and get quotes from those other trades to do it? Because I guess the best way that I can put this is, a valuer is human. They're human beings at the end of the day. They have differing opinions.
Yeah.
The best thing that we can do is we can paint the best possible picture we can of what the house is going to look like at the end, because at the beginning, they're working with a blank canvas, a wad of paper, and that wad of paper needs to tell them what's that blank canvas going to turn into at the end to be able to put a good value on it.
Absolutely. I think, and correct me if I'm wrong, a valuer has to err on the side of caution as opposed to give it the benefit of the doubt, because at the end of the day, they're legally saying, we think the house is worth this. Now, when emotion comes into it and you're going, oh, no, but we chose the black taps in the house, therefore it should be worth more, that's taken out of it. But if they're not sure, they're going to go more conservative. Is that how you see it?
Correct. But they are liable for the value that they put on that property. So when we're looking at a real estate agent and what they're appraising a house for, what they're ideally looking to do is sell that house for as much as they possibly can, which is why they go for that higher value, because that's what they believe they can get on the market for it. What a valuer is doing is, a valuer is going, if things go bad here for this customer, this bank's going to want to repossess this house and they're going to sell it as fast as they possibly can. We need to know that we're giving them a value that they can possibly sell it for really, really fast. Not what's the best market value. How much can they get it off their books for really quick and clear that debt? Yeah. That's what a valuer is trying to do.
I think what you just said then is key, because the valuation, if you think about it, would be very different if that house is on the market for a day, have to sell urgently, versus selling it over a year.
Correct.
And I think that valuation will be incredibly different. What's going to be that difference? Because the reality is that, again, they're looking after the banks. They work for the banks.
100%.
And just to expand on the process here. So what normally happens is, this is for people listening, is that we design the home, we get the working drawings done and the contract done. When they get the contract signed by the client, once it's signed up, they'll actually send those to the banks to value it, and they'll actually looking at, are you spending too much on the house for the area, or are you spending not enough in some cases? I know a client or a person that actually they put a first home buyer place in on the waterfront in Cottesloe, because they'll actually just wanted to rent it out. They don't want to build anything. That's what put it cheaply there. So that's undercapitalising. But they're really just trying to make sure they're protecting the bank for valuation. And I think people just need to understand that's the process behind that. But there is a point where you have a big enough deposit where you don't have to get it valued. Is that right?
To do a renovation or a build?
Well, yeah. So if you had let's say you were cash, you don't have to get it Obviously, not going to a bank in that case.
Not going to a bank.
But is there amount of percentage of equity or deposit that you have where the valuation is irrelevant? Like I can spend whatever I want on it?
No. A bank will always do their own valuation. However, just to put a little explanation behind that is a lot of them now. So the website RP Data or CoreLogic is where all real estate transactions are recorded through, whether they are a sale or a rental.
Yep.
So quite often that is going to be a real estate agent's first port of call when they're about to appraise a property, or a valuer's port of call where they're about to value a property. So what's happened over the last few years is a lot of lenders now, rather than requiring a physical inspection where a valuer actually goes out, walks around, looks at the property to be able to put a value on it, is if we are, coming to your point, borrowing, say, only 50% of the value of a home, they'll just do an automated valuation that comes straight from RP Data that says it's worth X, and as long as X is sufficient for the loan that they need, they're happy to run with that.
So it's like a curbside. Yeah.
Your curbside's going to be a drive-by. Okay. So there's a few different tiers. So automated, straight off RP Data. Yeah. Curbside's where they drive by. Then you've got your physical inspection where they go in. Yeah. But more often than not, with anything to do with a build or a renovation, a valuer is going to be involved because they need to try and picture what that end product's going to be. Yeah.
Just a little note there, drive-by is not a shooting, it's just a drive-by. It's just maybe a photography shot.
Curbside, drive-by,
Yeah, okay, just double-checking that everyone's aware of that. No one's going to get harmed in this podcast. So that's great. So they can access the equity, they've got enough equity there. What if they don't have much equity? Let's say they don't have enough equity. The banks go, okay, we're going to down value this. They want to spend $450,000, but the bank says, no, we're only going to let you spend $300,000. What happens in that scenario?
We're talking about a renovation?
Let's talk about renovation, yeah, okay.
So that sounds like it would be more a case of a borrowing capacity type issue in that sense. I mean, generally, if the valuation stacks up, then it's going to become more a case of, can they borrow the funds to be able to get that based on their income versus their outgoings? That's one point of it. But if there's, it would have to value relatively low, and more often than not, if that's going to be the case, there might not be a way around that, because sometimes people do sort of spend beyond their means when it comes to these renovations.
Yeah, absolutely.
And then it might just be a case of tightening the belt a little bit, which is, I imagine, where they're going to come back to you and go, right, well, what can we do to make this fit? Now, keeping in mind that those changes need to be in line kind of with whatever that valuer has already valued on it, because if you start changing things massively and we're really downgrading whatever the specifications are of that finish, then that's going to need to get revalued and will be valued accordingly as well. So it can be a little bit of a cat and mouse act.
They have to inject cash or something, money. Yeah, okay.
Yeah.
That makes a lot of sense. And so, how does age affect your loan? So let's say I'm 50, which I'm not yet close to it. But let's say I'm 50. Do they look at that differently as opposed to a 21-year-old, or does that come into it? Like your loan can't be as long. How does that sort of affect things? Or do you have enough money they don't care, or how does that work?
Well, I just turned 50 last year, Behan, so thank you for using that example and putting me in that bracket there. I see where you're going with that.
I'm just a young pup, so I wouldn't know.
No, it's fine. So with the banks, I guess the way to think about it is the average home loan is done over a 30-year term. That's just the way that they set it. The reason that it's set over a 30-year term, that dictates what the repayments are going to be based on whatever today's interest rates are and the amount you borrow. To say, if nothing else changes over the course of 30 years and all you do is make your minimum repayments, then in 30 years' time, that loan is going to be zero and it's paid off. So that's what a 30-year term does. It dictates what those repayments are. Now, at 50, that's going to take through to age 80. Now, I think statutory retirement age at the moment, is about 67.
Yeah.
So quite often the banks will look at that. And one of the things that we need to work out and determine with our clients is, what's your exit strategy come retirement age, or what age are you planning on retire, et cetera, et cetera. Now, you can't say, I'm not going to retire until I'm 100, because the banks won't be able to use that because the regulators say that you can't.
Yeah.
So effectively what we need to do is we need to go, right, we need to work out an exit strategy. What is your exit strategy? What do you believe your exit strategy is? Or we need to work with them on that, because I'll be honest with you, most people don't know what their exit strategy is. Yeah. They're just going day by day. So if we've got a 30-year loan term, and let's say 70 is a pretty standard retirement age nowadays that most people can work towards, that's 20 years. So when we're looking at it, we need to go, right, over that 20 years, this loan is going to amortize down to X, whatever that may be, just working on today's interest rates and what we're looking at in front of us. And that may be a $500,000 loan that may be at $200,000 at that point. If you had to retire at that point in time, what have you got behind you to be able to clear that debt? The most common one, superannuation.
Yeah.
So what we then do is we get their superannuation statements, and we need to work out, amortize that up the other way and go, based on your current salary, if your salary never changes, what's your super projected to grow to? And this is all done on a MoneySmart website online. It's a government website. So that's where we access that.
I hadn't thought of that. That's great. Yeah, gold.
So we access that, and we access and we work on the amortization of the loan down, projected growth of superannuation up at that 20-year mark.
So what do you mean by amortization? Sorry.
Amortization means if you today's interest rate, the amount of money that you're borrowing, if all you do is make your standard repayments over 20 years, what is your loan amortized down to? You haven't put any extra in, you've done nothing else, just what's it going to go down to just using the standard repayments.
Understood, yeah.
So then we're seeing that, let's say that's 500 and goes down to 200, and let's say superannuation at the time that we start this is 150 and grows to 300. There's 300 super that they've generated or grown. There's 200 debt that they owe. They can take a lump sum payment out of super, clear that debt, live debt-free in retirement, still have 100K surplus left over. That's what we're trying to project.
Gotcha. And that I hadn't actually thought of that, accessing that super, but yeah, it's a key part of it. It's there, but you can't access it yourself, but you can take that into account. That's
one of the options. Ideally, what we're looking at is people that have got other assets. If it's investment properties, sell the investment properties, clear the debt, move on.
Gotcha.
So there's other assets out there. Some people have businesses, et cetera, et cetera. It depends what the lenders will use, because not all of them use all of these things, but that's what we're trying to achieve.
But I think that comes back to what we were originally talking about, is why you see a broker. And by the way, I'm not pushing brokers here. It's the right tool for the right job, and they actually are the right people to speak to. Good ones, that is not. They're not all that great, but the good ones are good. But the point is, though, that I think it's really important to go is individual circumstances is what dictates the path to go down. And whereas one bank might not look at it, another bank will. So I think that's where brokers need to customise the solution to the individual, like you said, if your assets,
Every single time. And to be honest, not every bank uses every one of those exit strategies. Some of them won't allow lump sum payments from super. Another one's downsizing.
Yeah.
Some people have got the $1 million property that's got the 5 bedrooms in the big yard because they've got 4 kids.
Yeah.
But in retirement, those kids are going to be gone. That house is going to be too big for their means or too hard to maintain.
Yeah.
Are they in a position to be able to sell that?
Yeah.
And once the debt's cleared, how much is left over? Yeah. And is that going to be sufficient for them to buy the retirement home for cash?
Gotcha.
So there's downsizing as well, but not all banks will use that. So this is a bit of a juggling act as to working out where that's going to end up, and every policy is different with it.
But you can't just Google it. You can't. ChatGPT can only do so much. It's got to be tailored. All right. So let's say you could get a 30-year loan.
Mm-hmm.
Are you better off getting a loan over the longest period of time, or are you better off getting a shorter loan? Like I've had people go, I want to pay it off in 20 years, so let's get a 20-year loan. Is there a strategy behind that? Thoughts?
It's a conversation, because when that quite often comes up, and it's generally the people that have had their loan for already 10 years, and they're like, well, why would I get a 30-year loan when I've only got 20 years going on this one? And I'm like, well, let's ask you a few questions, because again, I'm catering this to whatever that client's needs are. If I go back to the analogy that I used before, where the 30-year term dictates your repayments. So if you get a 30-year loan term on a variable interest rate for this exercise, it's a 30-year loan term, then those interest rates, those repayments that are required are going to be based on that loan being done over 30 years. If we then go, you know what, I only want my loan over 20 years, well, that's fine. The interest rate doesn't change and the amount you borrow doesn't change. But now you're just taking 10 years off how long you've got to pay it. So that means your repayments have just gone up quite a bit, because now you've got to meet those repayments to pay it off in 20 years' time. And this is the conversation that I'll have with someone and say, so that's what you're saying is ideally what you'd like to do. The alternative is you can still set it over 30 years and still get the reduced repayments. But if you want to pay it off in 20 years, go for your life. Now you're in control of what your minimum repayments are every single month, versus the bank saying you have to pay this. Where am I going with that? Is life has its ups and downs. Circumstances are going to change, and things are going to happen where you go, you know what, things are really tight this month and I don't know that I can make my repayment. And if you're stuck on that 20-year loan term with the high repayments, it doesn't matter. That's what you've got to do. But if you've taken the 30-year loan term and you've given yourself the option, then you go, you know what, I'll just make my minimum repayment this month rather than continuing to strive to pay it off in 20 years. And it might mean that you pay it off in 22 years or 23, but you're in control rather than the bank taking out this money if someone's lost a job or there's a grieving from the family, or you have to go back to the UK because of something, or things like these. These are just random scenarios.
Yeah, it's giving you options.
You're in control, correct.
The other one to back that up is the flow-on effect for that is that you might buy this, have a 20-year loan, but then you might go, oh, I want to buy something else, maybe another investment property or whatever it might be, or access the equity to build. But then you've got the banks look at your repayments and go, well, that you have to make these repayments anyway, and that could hinder your chance to borrow more money if you wanted to.
Absolutely, because your borrowing capacity is based on money coming in versus money going out versus expenses. Yep. And if your expenses are higher because of that shorter loan term, to be honest, quite often we're needing to refinance the home loan first to stretch that back out to be able to increase your borrowing capacity for whatever step two might be, say the investment property.
Yeah. So you're better off having the options in front of you than not. No, and that makes a lot of sense. But again, not to say that, hey, go to use the be all end all, but this is where, I mean, we're giving you a lot of information today, but the reality is talking to someone like you who can then go, hey, look, let me just take all that stress away and let me just explain to you what you need to do for the individual, because there's too many elements to consider. And if you just don't know, then again, going to that one bank is just crazy to me. I see no better, because it costs the same going to a broker as just to the bank directly, right?
Yeah. Brokers have the option to charge a fee should they feel the need to do so.
Yeah.
So we do get paid a commission by the bank. So good to clear that right now.
Yeah.
Is historically, if we go back, I mean, even sort of, 10 years ago, let's say, most banks, you were going in, you were sitting down, they have overheads to have their branches open, they have wages to pay their staff and all these kinds of bits and pieces. And so with brokers, when brokers have sort of come into the market, effectively what the banks have done is they've gone, well, these brokers are introducing business to us that we never knew about because they were going to their own bank prior, and now they're being brought to us because we meet the needs of that particular client. So we're going to pay that broker a commission and say thank you very much for bringing this new business to us and introducing them. So all that's happened now is most of the banks have actually opened their eyes up a lot more to that and realised that's the way to go. Hence the reason, I mean, Bank West has just closed down all their branches.
Yeah.
So, there used to be a lot more branches here for us with police and nurses, ING, all these different lenders, Suncorp, for example, that you used to have around Perth, we don't have here anymore.
Yeah.
And that's because it's more cost effective for them now to pay brokers to do all the work, bring the business in, they just check it and make sure that, they're happy to lend to that particular customer.
Yeah.
So, there's no benefit. Time-wise or financially, there is absolutely no benefit to anybody going out there and just going door knocking on all the banks and trying to do this themselves. It's none whatsoever. We don't get paid any extra. All the banks pay almost identical commissions, so we're not going to be taking anybody to a specific lender because we get paid more. There's no benefit in that.
Yeah.
Again, I go back to what I said earlier on. We are relationship based. I want to do the right thing by you now because I want you to come back and I want you to bring whoever else along with you.
Well, absolutely, and that's just smart. It's not just trying to get this quick transaction. It's the long haul relationships. It's a big part of it. Okay, so and that makes a lot of sense to me trying to work that out. When you go to a bank, do you let's say because I always say you should work out how much you want to spend first when you're renovating a building or buying whatever, and work out what you're comfortable spending and what the maximum you want to spend is, because it might be very different. You might be able to borrow $5 million. It doesn't mean you should spend $5 million. Yeah. But I think you should have an indication of what you want to spend and also what the maximum you want to spend is. You don't have to tell a builder, you don't have to tell a real estate agent, you don't have to tell anybody, but just know what that is prior to get emotionally involved with a home. If you fall in love with a home that's way over your budget and you don't know your maximum, you can get caught up in that and all of a sudden you're eating baked beans the rest of your life because you can't afford to have a life outside of owning your mortgage. Is it hard to go to a bank and say, what's the maximum I can borrow, or do they need to have specifics? How does that sort of work?
I quite often have people contact me who've been told by a bank what they can borrow, but they haven't provided any information to them. It's been a conversation. And I'm like, well, no, I'm not going to do that.
Yeah.
I'd rather see a bit more from you. I need some tangible stuff. I want to give you answers that are going to sort of either take you to where you want to be or sort of steer you in the right direction. And to be honest, the majority of people out there have absolutely no idea what their borrowing capacity is unless they've been using some of these bank calculators online, and they're a bit vague too.
Yeah, I was going to how accurate are they?
No, not super accurate, not completely wrong, but again, I might be speaking out of turn here, but they're a marketing tool as well. They want sort of people to jump on there, plug a few numbers in and be pleasantly surprised, and hopefully get in contact with the lender and take the next steps from there and see where that ends up.
But they don't calculate mortgage insurance, from my experience.
To be honest, I've never got on and played with any of them. I just know that the numbers that customers bring me are quite different to what I'm telling them.
Well, this goes back a long time ago, but I remember where I was speaking to clients and they'd go, on $30,000, I can borrow $500,000. You're going, no, this is a long time ago, but it was. But mortgage insurance is a big part of that, which is a different conversation. But you're right. It's a marketing tool. Get them in, and then the banks can sort of filter through.
That's right.
The best option.
And look, mortgage insurance is not a bad thing, and it gets a bit of a bad rap out there, but without it, a lot of people wouldn't be able to buy properties, and we probably wouldn't be in the sort of property market that we're in at the moment.
Yeah.
Because without mortgage insurance, you've got to have that 20% deposit. And on top of that, the majority of us, unless you're a first home buyer, you have to have another 5% as well for your stamp duty and fees and all that kind of stuff when it comes to buying a property. So you need 25%. Now, there's not too many people out there that have got 25% readily available to go out and buy properties, especially not first home buyers, for example. So where mortgage insurance comes in is to go, and it doesn't necessarily need to be first home buyers. It can be anybody. If you just don't have enough deposit right now to be able to get away from mortgage insurance, you can buy that property. You can just where the mortgage insurance is like the scenario I said earlier, where the solution we get for you now might not be the ideal one, but it's going to get you there and we'll sort it out later.
Yeah.
It's a similar type scenario. Mortgage insurance just gets you in the door now. Mortgage insurance is just a fee you're paying to protect the bank in case anything goes bad.
Yeah.
And the bank never loses. They're not going to lose any money. So that's all that is, without me going into further detail.
Yeah.
But it shouldn't be looked at as a negative thing, because it does help a lot of people get into homes that otherwise wouldn't be able to.
Yeah, I 100% agree. I think it's one of those things where you go, it's like a leash, no, let's not get carried away here. Let's just pull this back. So, it's basically a conservative side of you.
Yeah.
Now, with mortgage insurance, and correct me if I'm wrong here, the banks have their capacity of how they see you, and then the mortgage insurance have their own way of valuing what you can borrow, how much expenditure you've got, and they'll say, okay, great. The banks might lend you this, 100% of whatever, but the mortgage insurers go, no, we're only going to insure you for this amount of money, and therefore any money above that, you would have to find your own money, but that's your problem.
Would you like me to do an explanation in a nutshell on mortgage insurance?
Yeah. It's a legitimate question. Yeah.
So effectively, most of the lenders now, if they either have what's called direct underwriting authority, which means that they're allowed to write home loans based on the guidelines of the mortgage insurer on behalf of the mortgage insurer without having to go and ask permission for it.
Yeah.
That's going to be your bigger lenders.
Yeah.
But ideally, it's kind of correct what you were saying there. The mortgage insurer they're there to insure the loan for the bank. The simplest way I can explain it is, if you borrow 80%, you don't need mortgage insurance. The bank has 20% equity in your home. So if we go back to that scenario where things go bad and for whatever reason that bank needs to come and repossess that house, they want to sell it as fast as they possibly can.
Yeah.
And they believe that with that 20% equity, they're going to get their money back, being the 80% that they've lent.
And you get the balance, whatever it might be.
Where if there is any balance, but generally no, they're just going to get enough to be able to cover the debt. They're not chasing top dollar.
Yeah.
So where mortgage insurance comes in is, let's say you go over that 80%, which means now you're going to borrow, say, 90%, for example. Now, instead of the bank having 20% equity, they've only got 10% equity. They need to get that loan. They basically say, we need to pass this loan over to the insurer and say, will you insure us in case, back to the scenario, things go pear-shaped and they need to repossess that house? They don't have that 20% equity in there anymore. They've only got 10%. They're still going to get to sell that property as fast as they possibly can and get it off their books. And the problem is that if they don't get enough to cover that 90% loan and they only get enough to cover the 80%, they make a 10% loss. No, they don't. They're insured for that 10% loss because that's what the mortgage insurance is to do, which means that now the bank is not losing, but that's why you get the mortgage insurance. So the customer pays for the mortgage insurance. It's a one-off fee, generally added on to the loan, but that protects the bank for the life of the loan. And that's purely what it's for.
Beautifully said. I know that's the first time you've ever explained that before. No, that was beautifully said because it's interesting. I've had many clients over the years turn around and go, if we default on loan, that's fine. We've got mortgage insurance. I'm going, no, that's not insurance for you. You're paying for the bank's insurance.
Correct.
And yes, it sucks. No one wants to play it, but you can't get a house if you don't do it. So, it's very often misconstrued about what that insurance is. Mind you, clients shouldn't be fickle about, if we can't afford it, we've got insurance. That's not how you should look at this because it's certainly a lot of money taken very seriously, which is great. Glenn, you've got a wealth of information and, you can tell by the way you speak because it's, you've explained all this probably a billion times before, but it's great that you've done this. Thank you for coming in. Got a question for you though, which we ask everywhere, which we've already worded you up, so you don't have to pretend like, oh my God, that's a great question. So you're building a renovating home, and I know you just got your house recently yourself, and someone gifted you $10,000 that you have to spend on the home, on anything to make it wow and to juice it up. What would you spend the 10 grand on?
Oh my God, Behan, that's a great question. I didn't see that coming.
Well, I just thought of it just then.
It's interesting because I thought, how does he want me to answer this? And I thought, no, that's not the best way to go. I've got two answers for you.
Authentically.
I thought if I was going to go down the path and just purchasing a house, Kim and I purchased a house ourselves. I'm thinking first thing that I thought of on the practical side is that I'd probably want to get the smart features within the home. So the biggest one for me is, in the current home, I still do this to this day, is because it becomes such habit when I'm pulling out of the house, I'll get about a minute down the road and go, did I shut the garage door?
Yeah.
And quite often I'll turn around, go all the way around the block just to go back and see that, I did.
Yeah.
But I can't continue on my journey without going back and double checking.
Because the day you don't check.
It's the day you leave it open.
Yeah.
So that would be the first one is that smart one, and purely because of that. But if I was going to be a realist about it, I'd probably put a golf simulator in a man cave.
Done a fair few of those recently. I can talk to you about that later. We've done a fair few.
Yeah.
Very popular. We actually did a social media podcast.
It's going in the new house, by the way.
Well, if you want some tips on that, I can definitely help you with that. That's awesome because you do love your golf. No, they're great suggestions. And I think smart homes is definitely the future. It's already here, but it's definitely evolving. And I think smart home, making your house automated in those ways, one, gives you peace of mind, but also you want to future-proof your homes for that cycle. That's great. And the golf simulator, mate, wet weather, sunny weather, too hot, got it all at home and can you share your handicap with us? What are you seeing at the moment?
My handicap's trying to find the ball after I hit it, which is why I need the simulator to try and fix that. But going back to what you said about the smart home sort of things it is the way of the future. And that's why I'm sort of, the more you look at it, the more you think it's going to become something that buyers out there are looking for when they're out there in the marketplace anyway. So,
it's something we actually do for all our clients. There's a whole heap of things that we include for our clients that we go, look, this is things you want to think about in the home. It's like, like automation, things like that, because whether you want that now or 5 years down the track, you got to be set up for it. It's a lot more expensive to put in later. And you're right, even things like turning your air conditioner on at a certain time, there's all sorts of different stuff you can do. It's the future, it's not going away, and everything's going to double up. But they're great ones to do. And also, thank you so much for coming in today. I really appreciate it. You are a wealth of knowledge. We refer a fair few people your way because we absolutely trust that when you talk to a client, you are going to look after their best interest. And I don't say that lightly. I've worked with many brokers over the years. Some are excellent. Few are excellent, I should say. Some are good, some are a lot are terrible, but I do think you're absolutely fantastic at what you do. So thank you. Thanks for your wisdom today. And I do encourage, if anybody is thinking about getting finance, that Glenn from Tag Finance is a great person to speak to. Really know your stuff. And what's really cool is that you can't help them. You'll absolutely, so we're not for you or whichever, you'll actually give them the right advice to them as opposed to trying to sell them a product that's not the right fit. But it just works. So thank you very much for coming in.
No worries. Thanks for having me. Enjoyed it.
Awesome. Thanks, mate. Cheers.
Cheers.